This is Module 2, and I will be talking about UITF products, the Unit Investment Trust Fund basics. So just to give you an idea, what are the major trust principles that you have to understand? So effectively, a trust is a relationship or an arrangement wherein a person called the trustee is appointed by a person called the trustor. So the trustor hires the trustee, and the trustor hires the trustee to administer, hold, and manage funds and or property of the trust for the benefit of a selected beneficiary. So just to remind you, these are the terms that we will be using. So the trustor is the person who causes the trust to come into existence. Any of the gains and losses of the trust are for the account of the trustor. So in usual parlance, this trustor is the client or is the investor. The trustee or the trust entity is the person who holds the title for the benefit of another. The trustee or the trust entity does not have beneficial interest in the trust property or fund. The one who has beneficial interest is the trustor, ladies and gentlemen. Okay, it is the trustor. The trust property is the property interest which the trustee holds subject to the right of another. So in effect, trust property could be financial assets, hard property. It can be the financial assets can be in the form of time deposits, fixed income securities, or equities. The beneficiary is the person whose benefit the trust property is held for by the trustee. So the beneficiary can be the same person as the trustor. In the case of UITFs, usually the trustor and the beneficiary are the same. In some other trust products, the beneficiary and the trustor can be different. A quick example for this would be the trustor is the mother or the father, and the beneficiary is the child. Okay, so that's some quick example. And the trust instrument is the document which property interests are vested in the trustee, and beneficiaries and the rights and duties of the parties are set forth. So, how about UITFs? What are UITFs? How do we define them? Effectively, UITFs are open-ended pool trust funds in any acceptable currency, pesos, dollars, euros, renminbi, whatever. It is operated by a trust entity, and these are made available by participation. These UITFs are established and maintained in accordance with the written agreement drawn up by the trustee. These include examples of which include the Declaration of Trust. The Declaration of Trust, or DOT, provide the guidelines in the management of the UITF and the plan rules. For UITFs, ladies and gentlemen, there are no maturity dates, unlike bonds, right, wherein there is a specific set maturity date. This allows investors to invest or redeem their investments at any time subject to the trust entity's guidelines. UITFs are express trust, meaning there is an express agreement between the trustor and the trustee and are not implied. These are established, administered, and maintained by a trust entity, subject, of course, to BSP approval or notification. Trust entities are not like mutual fund companies, wherein each mutual fund company has one fund. A trust entity may establish more than one UITF. So how does it work? Effectively, group of investors pool their funds together. They choose a fund manager. The fund manager then invests these funds into equities, bonds, or both, based on the investment objectives stated for the UITF. The fund manager through time will either actively or passively manage the UITF and generate returns for the investors. So this is how it looks. Remember, investors put their money together, they give their funds to fund managers. The fund managers chooses the outlets, they manage it over time, they invest it in securities, and the returns that it generates provides income to the investors. So how does it work? What are the investment outlets? Depends on the plan rules, but the investors give their funds to a group of fund managers, and fund managers then decide, based on the plan rules, will they invest the funds in cash, government securities, and corp bonds, or listed shares? What are the benefits and risks of investing in funds? Well, number one, in terms of benefits, there's potentially higher returns. Given that this is not a regular time deposit and you're investing these in capital market products, you may be able to generate higher returns compared to the usual savings account. Since you are pooling your funds together, it is more affordable since the fees are distributed across the investor pool. Since you are hiring through the UITF structure, professional fund managers, you have experienced personnel managing your portfolio versus doing it yourself. When you are investing in the UITF, there is diversity in the outlets and thus diversification. You can redeem from your funds whenever you see fit. So there is liquidity. Since you are provided the information as to what the fund manager is doing, there is provided information and transparency. What are the major risks? Number one, since they are not deposits, they are not insured by the PDIC, and the returns are not guaranteed. What are the major differences between UITFs and mutual funds? So the regulator of the UITF are the BSP. It's regulated by the Bangko Sentral ng Pilipinas. For mutual funds, these are regulated by the Securities and Exchange Commission. The structure, it is a contractual structure for UITF since you are buying and selling units. And for mutual funds, since you are buying and selling shares, it's a corporate structure. Since they are creating uh, a mutual fund company for each particular fund that they launch. As mentioned, you purchase and redeem UITFs through units of participation, whereas you buy and sell shares of a mutual fund. For governance, who handles the governance of a UITF? You have either the bank or the trust committee of a bank. And for the trust corporation, you have the board. For a mutual fund company, the one who is answerable with regard to governance is the board of directors. For management, of course, you have the trust group or the senior management of the trust corporation. Whereas for mutual funds, you have an independent investor company, a fund advisor, or a fund manager. When selling UITFs, who are the people who are authorized to sell UITFs and mutual funds respectively? For UITFs, it's a certified UITF salesperson, such as yourself when you finish this course. And for mutual funds, there are sales agents that need an SEC license to sell funds. Are there annual stockholders meeting? For a bank managed UITF, there is no such annual stockholders meeting. But for trust corporations, they do have annual stockholders meeting. For the mutual funds, on the other hand, each fund or each mutual fund company does have an annual stockholders meeting. There is no stated liquidity requirement for UITFs, although a lot of the fund managers make sure that they tuck it into their plans. Whereas mutual funds, you have specific liquidity requirements, as indicated here. What are the basic fund classifications? Well, the first category is the money market fund. A money market fund invests in bank deposits and fixed income securities with remaining terms to maturity of not more than 3 years, and they have a weighted average portfolio life of 1 year or less. So, what does that mean? In effect, if they're investing bonds, it, so if you're investing in bonds, these bonds have a maturity of not more than 3 years. And the average maturity of this portfolio is either 1 year or less than that. For fixed income funds, on the other hand, they have an weighted average rather, portfolio life of more than 1 year, and they cannot have investment in equities more than 5%. These are fixed income funds. Plainly because your mandate is fixed income, you cannot invest in equities more than 5%. For multi-asset funds, they have a diversified portfolio of fixed income securities, equities, and other allowable investments for UITFs. And for equity funds, these funds have at least 80% of their net asset value invested in equities. So what are the types of fixed income funds? Well, for intermediate term bond funds, you have a maximum modified duration of 3. For medium term bond funds, you have a maximum modified duration of 5. Whereas for long-term bond funds, it is greater than 5. So with regard to risk, the long-term bond funds would have higher risk since they are investing in securities that have a weighted average maximum modified duration of greater than 5. Medium-term bond funds, again, the maximum is 5, and intermediate-term bond funds have a maximum modified duration of 3. And among the three are the least risky. So what are the types of multi-asset funds, and what are their respective risk profiles? With regard to equity allocation ranges, risk profiles of at least moderate will have 5 to 20% investment in equities. At least moderate have equity allocation ranges of 21 to 40% in equities. For those that are moderate to aggressive, have a 41 to 60% investment in equities. And those that are aggressive have a 61 to 80% in equities. So what are examples of equity funds? So you have an equity fund, blue chip equity fund, a dividend paying equity fund, and a themed equity fund, such as an ESG equity fund. Favorite example, there's a lot of these in the market right now. You have several index tracker funds. These are examples of equity funds. What are the new UITF structures? You have the regular UITFs, of course. These are the UITFs that we have been discussing that are investing in either fixed income, equities, or multi-asset. You have a feeder fund, which feeds into another collective investment scheme, at least one collective investment scheme. You have a fund of funds that invests in several collective investment schemes, and you have a multi-class fund, which has different classes based on probably the minimum investment amount and the fees. And you have a distributing fund, which pays out additional units and which then can be converted into cash. So any trust entity may establish, administer, and maintain one or more UITF subjects to the applicable provisions under this section. For a feeder fund, you have to invest at least 90% of your assets into a single collective investment scheme. Why 90%? Of course, the client wants to be able to experience the returns of that particular target fund. So if you're investing in a global S&P 500 or a global fixed income fund, having 90% of the money into the UITF, you will be able to experience the returns of that particular target fund. What happens to the 10%? Well, the 10% can be used to service liquidity and can be used for special needs if there are payouts that need to be made for distributions. Feeder funds can also have separate classes or multiple classes. What is the fund of funds? Like the feeder fund, you can invest in other collective investment schemes. But unlike the feeder fund, you have more than one collective investment schemes or more than one target fund. You also likewise have to invest at least 90% of these assets into more than one. And the fund of funds can also have multiple classes. UITFs may invest in other pooled funds referred to as collective investment schemes, target funds, and are subject to the following. The objectives of the target fund are, of course, aligned with the investor fund. The target fund has no investment in other collective investment schemes, and the target fund shall include exchange-traded funds and other collective investment schemes. The target funds may be local, may be foreign, as long as the target fund is supervised by a regulatory authority. So if it is a local target fund, it is supervised by either the BSP or registered with the Securities and Exchange Commission. If it is a foreign fund, it should be registered, authorized, approved in its home jurisdiction by the respective regulatory authority. And that authority is a member of the International Organization of Securities Commissions, or IOSCO. So a feeder fund structure and a fund of funds structure effectively have similar structures. The client gives the money to the investor fund, the investor then invests in the target fund. The shares of the target fund are given to the investor UITF, and the investor UITF provides the units to the client. The same thing happens here, but you have several target funds for the fund of funds structure. Remember, for both, at least 90% of the assets of the investor UITF have to be invested in the target funds. What is a multi-class fund? A multi-class fund shall refer to a structure which has, number one, more than one class of units in the fund. It's invested in the same pool of securities and invested in the same portfolio and has the same objectives and policies. What does a multi-class fund do? It can actually promote efficiencies by eliminating the need to create additional UITFs, which have different classes, which have different fee structures. So a feeder fund or fund of fund can have multiple classes. A distributing fund, on the other hand, is a UITF that has income distribution features, whereby the income of the fund is distributed in the form of units called unit income. The income for distribution shall be determined by the trustee in accordance with the UITF's plan rules and is not guaranteed. So the income for distribution shall automatically be considered as redeemed from the fund. The plan rules of a distributing fund shall set an ex-date and a date payable as to the cutoff date for the unit dividend entitlement, that is the ex-date, and the date payable is the day when the unit dividends are actually paid out to the investors. The plan rules should very clearly state in plain language how the computation is made for the unit payouts. For distributing funds, when they distribute income, they may distribute the income of the fund subject to the conditions stated below. Number one, only from the cash received from interest income earned and cash dividends, and after the trustee has taken into consideration the following: the income for the period, the taxes and expenses, the sustainability of the distribution of income, and the investment objectives and distribution policy of the fund. These should be converted into equivalent units referred to as unit income, and it's based on the NAVPU at the first business day when units in the fund are quoted ex distribution. The participants of the fund shall be entitled to their prorate share in the unit income based on their outstanding units of participation on the distribution date. The distribution policy should also be stated, and this distribution policy should include the following: what are the sources of income for distribution, the frequency of distribution, the manner of the distribution of unit income, and for monitoring purposes, the trustee shall separately account for the fund's income due for distribution. And the trustee shall provide notice to each participant on the unit income, which shall contain the total amount of distribution, the NAVPU ex distribution rather, as its basis, and the total number of units for distribution. It should also include the unit income or the number of units for every unit held by the participant entitled for distribution. The creation of units that require BSP approval include fixed income funds, multi-asset funds, equity funds, fund of funds, feeder funds, and multi-class funds. And last but not the least, distributing funds. The creation of UITFs that only require notification to BSP are the money market funds, and the funds that fall under the same category of an existing UITF that the trust entity manages. How do you compute the net asset value and the net asset value per unit? Let me define what is first the net asset value. The net asset value is the summation of the market value of each investment of the fund, less fees, taxes, and other qualified expenses. All UITFs are marked to market on a daily basis, and marking to market is the act of assigning a value to the position held in a tradable financial instrument based on the current price of that instrument. So the prices are marked to market and daily. Under the mark to market basis or method of valuation, or M2M, the value of the investment is constantly adjusted based on market rates. All of the asset classes, fixed income, equity, cash, are based on its weighted average return. So a portfolio is composed of asset 1, asset 2, asset 3, all of which are mark to marketed on a daily basis. You subtract from them the trust fee, the respective taxes, other expenses and liabilities, and the sum of all these is the net asset value. So just to reiterate, cash and the deposits, and you add the market value of the investments held in the fund, the accrued interest on the deposits and fixed income securities, and all other assets and receivables, less accrued taxes, accrued fees payable, other accrued expenses, and all other liabilities. If you subtract from the gross asset value, all of this, that is your net asset value. How do you compute your net asset value per unit? You compute this by dividing the fund's NAV, or net asset value, by the total outstanding units. And by doing this, you're able to determine the beneficial interest of each particular unit. So the NAV pool is simply the net asset value divided by the total outstanding units of participation. How do you compute your return? It's simply your current net asset value per unit divided by the net asset value per unit at the start of the period minus 1 times 100. You multiply 100 to convert it into percentage. So an example for this would be, say you want to get your year-to-date return, your current NAV pool divided by your previous year and NAV pool minus 1 times 100. Whenever you compute your year-to-date ROI, you use your previous year-end net asset value per unit as your denominator. If you want to compute your year-on-year return, what you do is you utilize your current NAV pool and you divide it with the NAV pool of the same calendar date the previous year. Meaning, if you are investing on December 1, 2025, the NAV pool of the same calendar date the previous year should be December 1, 2024. Minus 1 times 100. The main differences of these two, you pretty much are using the same equation. The denominator is just the item that is different. Here, you use the previous year-end NAV pool, and here you use the NAV pool of the same calendar date of the previous year. You can compute 1 month, 3 month, or 6 month returns. And all you have to do is incorporate the NAV pool either 1 month, 3 month, or 6 months from the current date. Subtract 1, and you multiply it to 100. Remember, ladies and gentlemen, you only get this details for information. Remember, ladies and gentlemen, do not annualize ROI numbers for periods less than 1 year. So just to give you a quick example, if you want to compute your past 1 month ROI, your year-to-date ROI, and your year-on-year ROI, what do? Given that your current NAV pool, let's just say today is March 19, 2023, that is your current NAV pool. If you want to compute your NAV pool for 1 month, you simply utilize this number as your numerator, 115. The NAV pool 1 month ago as your denominator, which is 112, minus 1 times 100. That gives you a return of 2.68. Year to date is utilizing the NAV pool as of December, the previous year. So what you are doing is you're utilizing 115 as your numerator, 1110, which is your end December net asset value per unit, minus 1 times 100. That is your year-to-date return as of 3/19/2023. Your year-on-year return, your numerator is still 115 since it's 3/19/2023. You need the NAV pool of 3/19/2022. So you go here, you use this number, you use 105. So you're using the formula 115 divided by 105 minus 1 times 100. Your return is 9.52, and so on and so forth. So remember, all the returns are basically paper gain or loss until the investor actually redeems the units from these UITFs. Here is another quick example using looking at the returns and the number of units owned by the particular investor. So remember, ladies and gentlemen, when selling UITFs or when informing the clients about particular UITFs, remember that investors are generally risk averse. They prefer less risk to more for the same level of expected return. Obviously, you want more return for any level of risk. So given this example, investors would tend to gravitate to, let's say, given that Fund A and Fund B have both returns of 9%, people would tend to select Fund A because the risk is lower at 12% versus the risk of 15% for Fund B. Looking at it from a return perspective, assuming that both funds have a risk, probably measured by standard deviation of 12%, investors would gravitate towards Fund B because Fund B, given the same level of risk, has a higher return. So how do you select funds? One of the simplest approaches is to simply look at performance, such as returns. Is it sufficient to track only returns? You also need to account for the risk taken by the specific fund manager because the returns might not provide you with all the information that you need. So a common measure when you select fund is to evaluate the risk-adjusted investment performance. You utilize ratios such as the Sharpe ratio and the information ratio. Both ratios tell you how well the fund manager is able to balance between high returns and acceptable risks. And it allows you to see which fund is able to give higher returns with optimal risk taking. So how do you measure the Sharpe ratio, or how do you use the Sharpe ratio? To define it, effectively, you are measuring how well a fund manager performs by looking at the excess return generated for every unit of risk that the fund manager is taking. How do you calculate it? This is the return of the portfolio less the risk-free rate divided by the standard deviation of the portfolio. So the numerator is the excess returns generated by the fund taking risk, and the denominator is the amount of risk taken by the fund. Remember, RP is the return of the portfolio for that period in time. The risk-free rate is usually the short-term government instruments. So it can be the 91-day T-bill, it can be the 1-year government security, the 2-year or the 3-year government security. And the denominator is the standard deviation of the total portfolio. After computing the Sharpe, what is the general rule for evaluating the Sharpe? The higher the Sharpe ratio, generally, the better the fund. It shows you that the fund manager was able to generate higher returns on a risk-adjusted basis. Let's give an example. If Fund A and B have a similar strategy and both offer similar returns, but Fund A has higher risk and Fund B will have a lower Sharpe ratio than B, what happens? Simply put, if both portfolio managers have the same return, but Fund A has a significantly higher standard deviation than Fund B, what will happen? So using the returns of Fund A, which is 25.8, the risk-free return selected, which is here, the 91 T-bill, which is 0.5, and you divide that with the annual standard deviation of Fund A, which is 18.54, you have a Sharpe ratio of 1.36. So 1.36 means that for every additional unit of risk taken by the fund manager, they're able to provide an additional 1.36 unit of return. So that's what 1.36 stands for. For Fund B, it's 25.8, which is also likewise the annual portfolio return, less the risk-free rate, which is the 91 T-bill rate, divided by the standard deviation of the portfolio, which is 13.12 rather. As you can see, Fund B generates a Sharpe ratio of 1.93, which means that for every 1 unit of risk, Fund B generates, at least for this period, 1.93 additional units of return. So given this, you will always choose the higher number. So Fund B, having a higher Sharpe ratio, is probably the fund that you will invest in. So higher returns does not mean simply that the fund is performing better, but you also need to take account for the risk taken by the fund manager. So in this case, you take a look not only at the numerator, you take a look at the denominator. You would like to make sure that you have a higher numerator, or if you higher numerator once you subtract the risk-free rate, and you'd like to make sure that your denominator is lower. By having a higher numerator and a lower denominator, in this case, will tend to generate a higher Sharpe ratio. In this example, even if Fund B generated lower returns, 28.8 versus 32.5, because it had a lower standard deviation, 15.2 less 22.12, its Sharpe ratio was higher, and they were able to generate more units of return rather, for every unit of risk that they had taken. The information ratio, on the other hand, tells an investor how much excess return is generated from the amount of risk taken relative to the benchmark. The higher the number of the information ratio, likewise with the Sharpe, the better. How do you compute the information ratio? Similar to the Sharpe, but it has different components. So the numerator is the return of the portfolio less the return of the benchmark, or the active return, or outperformance. It's the active return over the benchmark. And the denominator, TE, is tracking error, or the standard deviation of the active returns, of the return of the portfolio less the return of the benchmark. The general rule, the higher the information ratio, the better. It shows that the fund manager is skillful to deliver higher returns over the benchmark, given the particular risk taken. A negative information ratio generally means that the fund manager failed to add value to the fund. In this case, the annual portfolio return of Fund A was 30.6 and Fund B, it was 24.8. The annual benchmark return is 17.6 for both Fund A and Fund B. The standard deviation of tracking error is 15.4 and 6.8 respectively. And using the information ratio formula, you can see that Fund B, despite having a lower annual portfolio return, has a higher information ratio. So Fund Manager B was able to generate outperformance over the benchmark more efficiently by taking on lower active risk compared to Fund Manager A. So when selecting a benchmark is a standard against the performance of the fund shall be measured. When choosing one, it is important that the benchmark of the fund are composed of similar securities. So a market index is an aggregate value produced by combining several stocks or other investment vehicles together and expressing their total values against the base value from a specific date. Indices are intended to present an entire market and thus track the market changes over time. So the plan rules should include the following: the description and key characteristics of the benchmark, and its use relative to the fund's objectives and investment strategies. The references from which detailed information on the benchmark can be obtained. On to module 3.